Hello, we're ready to start on Chapter 7. Can you believe we're already on Chapter 7? It just seems like the other day we were fearfully cracking open our books to try to learn this scary thing called accounting. And look at where we are. This chapter deals with plant assets. As we know, an asset is something that a company owns. Often includes things like cash and AR. What we're talking about today, though, are those long-lived assets, often called fixed assets, or in this case, we're calling them plant assets. It's something that the company needs to do what they're in business to do, but they're not purchased for resale. They're purchased to be used in the operations of the business. They have physical substance, they are of significant value, and they're expected to last longer than 1 year. This slide is a little bit of is not quite correct. Plant assets are critical to many companies' success, but many companies do not have much in the way of plant assets. My company, for example, we have a few desks, some file cabinets, and some computers. Our percentage of plant assets as a percentage of total assets is very, very small, much like Microsoft. Whereas look at Wendy's and JetBlue. They need equipment and property and such to perform their operations. So while plant assets are critical to some companies' success, they are not critical to every company's success. This is a principle that we have talked about in the past, that anything we purchase is recorded at cost, and that includes our plant assets, our fixed assets, our property, plant, and equipment. Cost, though, is not just the check that you write for the item. It also includes all the expenditures that are necessary to get that item ready for its use. These are called capital expenditures. Cost included in getting that asset, that fixed asset, ready to perform its duty. This other word that they have here, this revenue expenditures, those are items that we expense immediately to the income statement. We're taking those costs immediately against revenue. It's nothing new. It's what we've been doing all along when we expense items. They just like to throw a new word in here. All right, cost is measured by, of course, the cash that we pay, the check that we write. But sometimes we have a cash equivalent. Think about the last car that you purchased. Did you trade a vehicle in? So that's part of the cash equivalent price. So the cash equivalent is the fair, I love the way they do this, fair market value of the asset given up or of the asset received, whichever you can more clearly determine. Land. Land is an interesting item. If you have a building, you probably have land. The cost of land includes everything necessary to make the land ready to use. So the price you paid for the land, all the closing costs, the property taxes, all of those things that is necessary to get it ready to be useful for what you're doing, including some other things. So this company bought land for $100,000. The property had a warehouse on it already that had to be torn down. The cost to tear it down was $7,500, but they did receive $1,500 from salvaged materials. You know, you take stuff to the junkyard and they pay you. There was also an attorney's fee and the real estate commission. So what is the cost of the land? The cash price, the net between tearing the warehouse down and our salvage value, our attorney's fees, and the commission. So the total cost of the land is $115,000. We wrote more than one check and we received some money back, but the total cost of the land is $115,000. Now I'll say this here and we'll talk about it again as we go through this chapter, but land does not depreciate. Depreciation should not be a foreign subject to you. We have talked about it briefly in previous chapters. But land does not depreciate. Land improvements. Now that's different than just the cost of the land. Improvements are what we have to do to get it ready for use. Driveways, sprinklers, extensive landscaping, not just, when you're throwing mulch out, but the original landscaping. Things that will have limited useful lives. And then we will depreciate those items over their useful life. We'll talk more about what that means as we move forward. But the basics is we try to determine, and there's a way we do this, how long, let's say, parking lots are expected to last before we have to redo those parking lots. And then we take a portion of the cost of that against our expenses each accounting period. Buildings, again, it includes everything needed to get either the building purchased and ready for use or constructed and ready for use. So all the purchase cost, all the remodeling, or all the contract price, plus all the extra fees that come in when you're building. All of those things are part of the cost of the building. Same thing applies to equipment. This is a little redundant here. It includes all the cost in purchasing the equipment, getting it to the facility, and preparing it for use. So if you have to have someone come in and set up or install the piece of equipment, if it had to be shipped, if you had to pay certain insurances during the time it was in transit, all of those become part of the cost of the equipment. Here's an example. Bought a delivery truck for $22,000. Sales tax, painting and lettering, motor vehicle license, and a 3-year insurance policy. This looks a little different. Let's talk about this. What items are necessary to purchase the vehicle and get it to our facility so that it's ready to use? What items might be considered reoccurring items that would simply be maintenance or expenses that occur annually or regularly? Well, we know the cost of the truck was $22,000. We're only going to pay sales tax once. Hopefully, we're only going to paint and letter the vehicle once. But now the license we'll have to buy every year. And an accident insurance policy, this is a 3-year one, but that's normally an annual expense. So what would the cost of the truck actually be? The cash price, the sales tax, and the lettering would be the cost of the delivery truck. The other items would either be immediately expensed, such as the $80, or set up as paid it in advance. That's right, a prepaid. So let's look. Our entry on our balance sheet would look like this. Our cash that was paid out, the total cash, our prepaid insurance, the cost we're assigning to the truck, and then the expense of buying the license. Now, at the end of the period, when we're doing adjusting entries, we would look at our prepaid insurance to see if we have actually used up some of that insurance. During the life of the item, most of the additional costs that will be incurred are going to be maintenance and repair items. They're items that have to be handled just so the equipment, the vehicle, the building continues to be useful. New tires on the truck, painting a room in the building. Equipment has to have, I don't know what they do to equipment, some sort of maintenance, I'm sure. Don't laugh, I don't do this. I mean, like maintain equipment. Now, if we do something to the building, the truck, the equipment that actually increases the efficiency, the capacity, or the life, then that is used to increase the plant asset that is affected, and those amounts are then depreciated also. This is interesting. Why don't you take the time to read it, because it kind of tells the story of how assets, plant assets, and depreciation can be used to, let's say, cook the books. What is depreciation? We talk about it a lot, but what is it? A company wants to match the expenses of the business against the income or the revenue that it is generating. And that's pretty easy when you're talking about payroll or utilities or rent or insurance. But what about this equipment and such? The buildings. They're necessary to earn the revenue that we do, but they're over here sitting on our balance sheet as an asset, when in fact, they're being used in the business. Depreciation allocates some of the expense of that equipment, vehicle, building over its useful life against the revenues generated by the business. It's cost allocation, not asset valuation. What we're looking at is not trying to determine the item's fair market value, but we are trying to use a systematic means of allocating some of the expense to our income statement. Also, we know that the ability of that asset to produce revenue will decline over time. The truck that I have today won't generate as much revenue 5 years from now as it does today. How do we compute depreciation? Well, we know the cost is everything that it is necessary to get the item here and get it ready for use. Useful life is the expected life of the item. Salvage value, what can we get out of that item at the end of its useful life? What might its trade-in value be? What might its salvage value be if we took it to the junkyard? What might its resale value be? These are things that we need to understand when we're ready to talk about computing depreciation. Now, useful life. The book talks about how, based on history and our knowledge and all of this, actually, useful life is computed in a much easier fashion. FASB and IRS both have charts of expected useful lives of different classes of vehicles, equipment, and or buildings. So it's pretty easy to determine the useful life. Let me go back here a second. Oops. All right. Do you see this helpful hint? Depreciation expense is reported on the income statement. That's absolutely true. The expense for a period is printed on the income statement. Accumulated depreciation is reported on the balance sheet as a deduction from plant assets. Remember that accumulated depreciation is a contra asset account. It is not an actual deduction from the cost of the plant assets. It's the net of the costs and the accumulated depreciation that will show on the balance sheet. There are a number of different methods of depreciation. Straight line, declining balance, units of activity. We're going to talk a little more in depth about the straight line method, and then just in a general fashion about declining balance and units of activity or units of production methods. Straight line depreciation is the most commonly used depreciation in the United States. It's the simplest to calculate, the simplest to use. It's there. And since we're not trying to actually match the decline of the item with a depreciation factor, it's fine to use for about any type of plant asset. So let's look at this. Let's first say Bill's Pizza bought a delivery truck, $13,000, expected salvage value of $1,000, life of 5 years, or useful life of 100,000 miles. So we're going to look very quickly at computing depreciation. Remember, the one that we really want to look at is straight line. While we'll show you the other two, we're not going to spend a lot of time learning how to compute those. Straight line depreciation is the same amount each year. The way it is calculated is to take the cost minus the salvage value divided by the life. So in this case, it would be 13,000 minus 1,000 for a depreciable cost of 12 divided by 5 years. So our annual depreciation expense is $2,400. It's very simple to calculate. Cost minus salvage value or trade-in value, or there's another word for that. I can't think of it right now. Divided by the useful life. So for straight line, depreciable cost is $12,000. In the book, it talks about another way to calculate this, and that is by using a percentage rather than doing the fraction, cost minus salvage value divided by life. If it's depreciated over 5 years, that's 20% a year. If it's depreciated over 10 years, that would be 10% per year. So you could actually do it this way and come up with the exact same numbers. Our annual depreciation expense is $2,400. At the end of year 1, our accumulated depreciation is the same as our annual expense. Book value is the difference between cost and accumulated depreciation. So our book value right now is $10,600. Now be careful. This $12,000 is the depreciable cost, not the full cost. So your book value is full cost minus accumulated depreciation. Year 2, our annual expense is absolutely the same, but our accumulated depreciation has now increased to $4,800. Accumulated depreciation is all the depreciation to date. The annual is just the expense for the period. The accumulated is everything to date. Our book value is now $13,000 minus $4,800 to get our book value. And this goes on year after year after year. And as you see the accumulated depreciation increase, the book value decreases. Until finally, in the last year of our depreciation, our book value is exactly what we had determined to be the salvage value. Just take a moment and kind of look at that. Now, this is all assuming that the vehicle was purchased on the first day of the year. Well, what happens if we purchased it in April instead of January 1st? Your depreciation is the same with the exception of the first and last years. In the first year, we're going to do our partial year calculation, kind of like we did when we were calculating interest. So we're only depreciating for 9 months out of the 12. So to calculate, we would want to do our partial year. And in the final year, we're only depreciating for January, February, March. So 3 months out of the 12. But we wind up with the exact same numbers. Our accumulated depreciation is $12,000, which means our book value is the same $1,000 because we have a $13,000 cost. Declining balance method is an accelerated means of depreciation. What does that mean? Well, with our straight line, we took the same amount of depreciation year after year after year. Accelerated depreciation takes a larger amount of depreciation in the beginning years and then smaller amounts as the year goes on. The declining balance method has several different calculations you can use. You can just use declining balance. You can use double declining balance. Double declining balance is roughly double the straight line rate. But that rate, instead of being applied to cost, is applied to book value. Again, we're not going to go in depth with this. It's simply a different means of calculating depreciation. You need to know that it's an accelerated method, which means the most depreciation is taken in the beginning, and then it decreases over the asset's useful life. This is an example of how it's calculated. Beginning book value. Now notice, we're not using the $12,000. We're not considering the salvage value when we're doing our calculation. Double declining balance rate, our annual expense, accumulated, same in the first year. Book value is cost minus the accumulated depreciation. And as you can see as we go through here, each year the annual expense goes down because we're calculating based on book value, not based on cost. And that book value continues to go down as we calculate. Now, this is important. You cannot depreciate below the salvage value. So in the 5th year, your calculation may be different than what we need to get that just to $1,000. So your 5th year may not rely exactly on a calculation, but rather on your ability to match to get the number that is necessary. Now, many companies would have gone on to the 6th year to finish that last little bit of depreciation expense. I'm not going to ask you to calculate declining balance. Simply understand that it is different, that it is an accelerated means of depreciation. This is the partial year calculation. And you will see in the first year we use the same partial year that we used in the beginning. And when we get down to what would be the final year, because this one would have a sixth year, since the first year was only a partial year, you plug the number that is necessary to wind up with your $12,000 in accumulated depreciation. Units of activity or units of production. Some companies will use this method because it calculates depreciation based on the actual use of the item. Think a piece of equipment at a manufacturing plant. It stamps out, the equipment stamps out a unit, a widget. How many widgets did it do? That's how we calculate the depreciation. Again, we go with depreciable cost, that's cost less salvage value, and it varies each year based on the amount of activity. Some companies use this for vehicles, and they do their depreciation based on mileage rather than using a straight line and basing it on just an annual amount. Here's an example. How do we calculate? Well, with this truck that we have, we assumed it would get 100,000 miles before we had to replace it. Divide your depreciable cost by the units to get a per unit amount. And then each year we would multiply that per unit amount by the activity for the year to get our depreciation. So here's that example. We need miles driven, the rate per mile, the annual expense, and these two columns are the same, our accumulated depreciation and our book value. So you can see how this varies each year based on actual activity. When we drive more, the depreciation is higher. When you drive less, it is lower. Straight line was the same each year. Declining balance was more in the beginning and less at the end. Units of activity based solely on how much activity there was. Now, in the final year, we may not have had exactly 10,000 miles driven, but that is all that we can use because our estimate was based on 100,000 miles. And we see here that our book value ends at the $1,000 of salvage value. Look at the difference and look at the similarities. They all wind up with $12,000 in accumulated depreciation. But how we got there was completely different depending on the method used. Many companies that have manufacturing equipment believe units of activity or units of production matches more closely the actual depreciation of the equipment. Other companies believe declining balance with higher depreciation in the beginning matches more closely how the fleet of vehicles depreciate. Others simply say it's the same year after year. This is just a picture illustration of what you saw in the previous slide. Depreciation and income taxes. IRS uses its own depreciation methods. You are not required to use the same for both, although many companies do, because it makes understanding the financials and comparing them to income tax returns much easier. You must disclose in your notes what method of depreciation you are using and if anything has changed. There may be times that it is necessary to revise our depreciation. Something has changed. We feel that it's depreciating quicker or not so fast. Maybe it's becoming obsolete quicker than we thought. There's a lot of reasons that we may need to revise the depreciation, but we do not restate prior year financials. We make the change in the current and future years, but not in prior periods. It's not considered an error. It's just a restatement of what we believe. An illustration. Equipment was purchased for $510,000, useful life of 10 years, salvage value of $10,000. They've recorded depreciation for 7 years. In 2017, year 8, they determined that the total life should be 15 years with a salvage value at the end of that time instead of 7 years and $10,000. We do not need to correct prior years, but we would have to calculate a different depreciation from 2017 forward. So we have to establish, I can't speak right this moment, we have to establish our net book value at the time of the change. So we took our original cost minus our salvage value, how much depreciation we've taken to date, and our net book value as of this day is $160,000. Based on that, we subtract our new salvage value to get our depreciable base and recalculate over the remaining 8 years of life. So when there is a change, it is not restated previously. We take it from that moment forward. What's an impairment? No, it's not when the cops stop you and you're not walking straight. That's a different impairment. Impairments mean that the fair market value of the item has had a permanent decline. What did we say our financial statements needed to be? Oh, that's right, accurate. Accurate, timely, and usable. Well, if we have something on our books for an amount of money that we know is no longer correct, our financial statements are not accurate. So we don't want to overstate. We need to write down that asset to its fair value during the year in which the decline occurs. We can't take it in the year when we have a large profit and we need a write-off. Or we can't take it in a year where we've already got a loss and it's not going to matter. It's supposed to happen in the year in which the decline happens. What if we sell an asset? Well, we have to do something with that also because it's no longer ours if we sell it, correct? First, we want to look at the book value. Remember what book value is? Original cost minus accumulated depreciation. We want to look at the book value and compare that to how much we received from the sale of the item. If we received more than the book value, we had a gain. If we received less than, we have a loss. We also have to get the item out of our books. So, Bright Company sold office furniture for $16,000 cash. It originally cost $60,000. As of January 1, it had accumulated depreciation of $41,000. Apparently, we were depreciating that at $16,000 a year. I'm just guessing here. but it says depreciation for the 6 months is $8,000. So the first thing we want to do is record our depreciation for the first 6 months of the year so that our depreciation for that item is up to date. So we're going to record the $8,000 for depreciation from January 1 to June 30. We've increased our accumulated depreciation and increased our expenses, our depreciation expense. Now, depreciation is a weird little thing. Depreciation has no effect on cash ever. Depreciation is one of those items that is simply a book entry that has nothing to do with cash. Keep that in mind, because just about everything else we do eventually involves cash, but accumulated depreciation does not. Now we can calculate the rest of the information. Our equipment and our accumulated depreciation, $60,000 less $49,000 gives us a book value of $11,000. Our proceeds were $16,000. We had a gain. So when we enter that item in our book, we will note first in cash the amount of money we received from the sale. Now, this isn't the amount of money we receive for depreciation. This is what we receive for the sale of the item. We're going to take the item out of our plant asset inventory, in this case, equipment. We're also going to reverse the depreciation that we've had to date. We want both of these accounts to become zero. And then we'll record the difference as gain on disposal. This amount is recorded below the line after our net income or loss from operations, in that section at the bottom of your income statement for other items. Now let's go back and say, well, we only sold it for $9,000 instead of $16,000. Well, if we look at that, our book value was $11,000, our proceeds were only $9,000. We had a loss this time. Same thing, we'll record our cash, we'll reverse our equipment and reverse our accumulated depreciation, there we go. And we'll record the difference, which is our loss, as a loss on disposal of plant assets. Take some time and think about that. Just remember, book value, if it's more than the sale price, we had a loss. If it's less than the sale price, we had a gain. Sometimes plant assets just have to be retired. They're like, well, I was going to say us old people, sometimes we're just not useful anymore, but I'm still useful. But no cash is received, but the item is no longer useful in the business. We're not going to be able to sell it. We're not going to get any salvage value out of it. It just needs to go away. So we reverse our accumulated depreciation and we decrease the asset account for the original cost. If the item has not been fully depreciated, we may recognize a loss on that item. Next, we're going to talk about intangible assets. Intangible assets are things of value to the company that you cannot touch. I can touch my plant assets. There's the piece of machinery. I can see it, I can touch it, it's tangible. I cannot touch my intangible assets because they're rights, privileges, advantages. They generally do not possess any physical substance. Intangible assets may have a limited life or an indefinite life. Names that you will hear are things like patents, trademarks, copyrights, trade names, franchises, goodwill. And no, that's not the movie Good Will Hunting, just so you know. If an intangible has a limited life, and that is a life that either by law or something else we say this intangible only holds value for this period of time, we amortize it. What's that, you say? It's depreciation for intangible items. That's all it is. It's amortization instead of depreciation. For our purposes, instead of having an accumulated amortization account, we will credit the asset account directly and debit the amortization expense account on our income statement side of our equation. Indefinite life intangibles are not amortized. We don't know how long they're going to be of value to the company. So let's talk a little bit more about those. I'm not sure what I did there, but it didn't. There we go. All right, patents. Exclusive right to something for 20 years. You capitalize, remember what that means, capitalization. We're not expensing it, we're placing it on the balance sheet as a long-lived asset. You capitalize the cost of either purchasing or getting the patent and amortize it over 20 years or, and this is important, its useful life, whichever is shorter. Not everything that we get a patent for lasts 20 years. A computer chip may not even last 3 before something new and better comes out. So you have to determine either its useful life or if it will be good for the 20-year period. You expense any research and development cost. There's a whole lot of argument about whether those should be expensed or capitalized, but FASB says that we are to expense any research and development cost because most often R&D costs do not result in a patent or a product. Quite often R&D is simply just an expense. Legal fees, if we have to successfully defend a patent, are capitalized as part of the patent account. National Labs purchased a patent. You don't always have to develop the patent. Sometimes you can buy those from other people. They purchased the patent for $60,000. I have several clients that have developed and had either processes or equipment patented. 2 of them currently use those in their business. 1 has turned around and sold his patent. National estimates the useful life to be 8 years, so we will take $60,000 divided by 8 to get our annual amortization. Amortization is always on a straight line basis. There is no salvage value, so it's simply the cost divided by the useful life. And because this was on June 30th, we will only amortize for 6 months of the year. So we're going directly against the patent and amortization expense for the other side of that entry. R&D, as I said, these are expensed when incurred. They often do not lead to a patent or anything else, copyrights, processes. So they're always expensed when incurred. Copyright gives the owner the exclusive right to reproduce or sell artistic or published work, and is granted for the life of the creator plus 70 years. Capitalize the cost of acquiring and defending, and amortize to expense over its useful life. The useful life is generally much shorter than the legal life, just depending on what is being trademarked or copyrighted. Our book, these PowerPoints, have a copyright to them. What's the useful life of that copyright? Trademarks and trade names. We all know the Nike swoosh. We all know the Amazon smile. We all know so many of the symbols and signs and jingles and names that are part of our lives. You have legal protection for an indefinite number of 20-year renewal periods. There's generally no amortization, because there's no end to that life as long as that item is still being used. Franchises. We all know franchises: McDonald's, Subways. How many? Shell, Marriott's. If it has a limited life, we can amortize it. But most franchises have an indefinite life, so they are carried at cost on our books until either they are impaired, no longer of value, or the life has an end in sight, and we can actually then amortize over that shorter period. Most often, franchises also come with an annual franchise fee, which is simply an expense and not part of an asset that we would set up as an intangible. Goodwill. Now, this one is so difficult. Goodwill is the things that we can't really count or measure about a company. Do you know what my most valuable asset is? It's my client list. But it doesn't show on my books anywhere. Goodwill includes things like client list, reputations, employees, what people think of our products. But there is no way for me to measure that goodwill and do some sort of entry that would get it on our books, because there's no dollar amount that's exchanging hands if I try to put my own goodwill on my books. But let's say one of you decides to buy my company. Let's say you pay me $500,000 for my company. What are you getting? A few desks, a couple computers, and the reputation of my company and my client list. You have now bought goodwill. Goodwill is the excess of the purchase price over the identifiable net assets. We can't record internally created goodwill. It's not amortized because it's considered to have an indefinite life. But at some point, it will become impaired because, let's say you bought my company, the name Hudson Business Service 20 years from now will not hold the meaning that it holds today. So how do we analyze these things? Remember, that's part of what you do as managers, is analyze your financial statements. Return on assets. The amount of net income generated by each dollar of assets. Simply divide net income by average total assets. Oh, what's that average total assets means? That means the assets at the beginning of the year plus the assets at the end of the year divided by 2 to get an average. And then simply divide that into your net income. JetBlue is 6.8, Southwest 5.7. The industry average is 4.0. This is an industry average simply for airline companies. Each industry has its own. Whether the return on assets is good or bad depends on the business, depends on the industry. You can never take a simple ratio and say it's good or bad without knowing the underlying story. Asset turnover. How efficiently do we use our assets? So for this, we're going to take our net sales divided by our average total assets. Before, we took net income divided by average total assets. This one is net sales. Okay, let's see, what's net sales? Net sales would be total revenue less returns and allowances and less discounts. Remember that? Average or net sales. And we're going to divide that by our average total assets. Our industry average is 0.80. JetBlue and Southwest are close. Southwest's average looks pretty good. JetBlue seems to be doing a little bit better in 14 than they did in 13. Again, these are simply numbers unless you know the underlying story. Profit margin. We've talked about this before. How effective is a company in turning its sales into income? Income being the profit at the end of the day. So net income divided by net sales times net sales divided by average total assets gives us our return on assets. Net income divided by average total assets. So this is something we've already looked at, but now we're looking at it in an expanded fashion. Southwest was more effective at generating sales, while JetBlue was better at deriving profit. So different ratios means different things. And with that, we are at the end of this chapter. Thank you once again.